Welcome. My guest is market strategist and venture capitalist and author and blogger Peter S. Cohan. Peter, last time we talked, Egyptians were taking to the streets. You were talking about the threat of $10 a gallon gasoline, and many economists since then are saying that perhaps the worst is over and that prices for oil and other commodities actually will sort of decrease here in the immediate future. Welcome, and what do you think about all that?
Well, I am delighted that things have changed since the last time we talked. The thing that I'm particularly excited about is that back in December, I gave a sort of prediction that in 2011 the commodities bubble would burst. And the reason I thought the commodities bubble would burst was because I just thought that there was too much capital flowing into commodities that was driving up prices well in excess of the supply and demand for the physical goods. And in March, I called for the regulators to put a limit on how much cash could flow into these transactions from traders and speculators by raising the margin requirements. And finally, about a week or two ago, they started to do it. And as soon as they did it, the price of these commodities went down.
So that, I mean, and commodities are naturally pretty volatile anyway, and this is a good thing overall for things to stabilize slightly?
Well, the interesting thing is that based on a regulatory change in 1992, Goldman Sachs' subsidiary J. Aron was able to convince regulators to allow speculators to take a larger portion of the total volume of trading on the commodities exchange in Chicago. Before that change, they only could trade a fairly small proportion, but the most recent numbers that I saw were in 2009 after the run-up of oil prices to $147 a barrel, and the Commodities Futures Trading Commission did some research and discovered that during that time when the price of oil went up to $147 a barrel, the commodities exchanges were dominated by these speculators to the tune of 81% of all trading volume. To put that in simple terms, that means that Goldman Sachs and hedge funds were controlling 81% of the trade in commodities, and only 19% of the trade was controlled by companies that actually use oil, for instance, like refineries that take the oil and they turn it into gasoline. Only 19% was done by them. The other 81% was done by speculators. So the way I thought about it was that there's the Fed, which has basically set interest rates at zero. These banks and hedge funds can borrow the money risk-free at 0% and put a little bit of it into a commodities trade. So to give you an example of this, before they raised these margin requirements, a trader could control 1,000 barrels of oil if they put $6,500 into an account with the CME Group, which is the biggest commodities exchange in Chicago. And that meant that, for instance, with $6,500, if oil was trading at $100 a barrel, they could control $100,000 worth of oil. And what this means is that very little capital is required to control a large amount of the oil. And so they were taking that money, putting it into the contracts, and at the same time they were shorting the dollar, namely betting the dollar would drop and using that capital to bet on a drop in the dollar. Now, since oil is traded in dollars, if they can bet on a decline in the dollar, what that does is it actually creates a sort of self-fulfilling cycle where an ever lower dollar leads to a higher price, which they're betting is going to happen, and they keep putting more and more money into this thing. Meanwhile, the supply and demand for crude the supply was unchanged and the demand was down. The supply was unchanged because even though Libya cut off 1.5 million barrels of production a day, Saudi Arabia decided to make up the difference. Meanwhile, in early March, the tragedy in Japan took place, which caused them to shut down 29% of the refineries and reduce their oil consumption by 1 million barrels a day. So essentially, supply was unchanged, demand dropped. At the time before all that happened, oil was trading $85 a barrel. It should have dropped instead of going up from 85 to 113 or 115. So basically what you saw is all this was happening because of these traders. And when you put the margin requirements higher, what that does is it puts more capital at risk for these traders, and they sell their positions, and that creates a self-fulfilling prophecy on the downside, because what they have to do is they have to maintain a minimum amount of margin, and if they have a loss in their position, they have to put more capital in right away, which they do by selling their positions to raise the cash, and that causes the price to go down even more. So you see the selling panic.
Mm-hmm. So going back to our last interview, the best case scenario is what seemed to have won out here. I mean, looking ahead, since it takes about 6 months for changes in commodity prices to affect consumers, long range, the next 6 months down the road, we've probably hit a peak here. Some inflation is kind of good for the economy overall, but we've kind of stabilized, do you think?
Yeah, I think that what's going to happen is that the price of oil is going to drop back down to where it was before all this happened, losing about $30 a barrel, hopefully, and that will add 1.5% to GDP growth. So that'll bring us into around the 3.5% to 4% growth rate, and probably will continue that throughout 2012 unless some other unpleasant surprise takes place, which could, easily happen. The other thing is that the price of oil will drop, but the price of gasoline will stay as high as it possibly can, because the oil companies like to squeeze every last drop of profit.
Mm-hmm. Finally, too, going off the table here to a comment I heard you make on Marketplace this morning. Let's talk about briefly the NASDAQ and the NYSE. That deal fell through. What's going to happen now?
Well, they're going to merge with Deutsche Börse, so now the New York Stock Exchange, which was the original stock exchange of the United States, will be owned by a German company. And what will probably happen is that the other company that wanted to merge and dropped out of the bidding this morning will merge with somebody else. And my guess is it will merge with the CBOE, the Commodities Board of Options Exchange, which has a much more profitable business than the trading of stock, which is not a very profitable business.
So having the NYSE run by a German firm, does that scare you in any way?
Well, not really, although I do admit that, knowing that we were at war with Germany not too long ago, it seems kind of strange from an emotional standpoint that we are now, our New York Stock Exchange is owned by a German company.
Well, we appreciate your time, Peter, and look forward to speaking with you again. Peter S. Cohan with Peter S. Cohan & Associates. He is a market strategist and venture capitalist. Always a pleasure, Peter.
Thank you.